What if you could turn just $9 a day into millions, or even pay you more than your job? It sounds unbelievable, but it's not. Most people overcomplicate investing. They chase hot stocks, panic during downturns, and stress over timing the market, usually with poor results. But what's the good news? You only need 4 index funds to make it work. That's it. It can give you everything you need: foundation, resilience, growth, and income. I call this the wealth quadrant system, and in this video I'll break it down for you step by step if you prefer index funds. I'll show you and Josh 4 index funds that complement each other, how they've performed over time, and why one of them alone has the potential to generate life-changing passive income. In the end, I'll show you how these 4 funds come together to build 2 powerful portfolios. One is income-focused, paying you around $7,000 a month in dividends. The other is growth-focused, compounding into nearly $1.9 million in value, and all it takes is just $9 a day. Before we look into the 4 index funds themselves, let's step back and talk about the system that ties everything together. Because without a plan, investing feels like guesswork. But once you have a clear framework, everything makes sense. So, what is the wealth quadrant system? Think of it like building a house. You wouldn't just start stacking bricks and hope it turns into something stable. You need a blueprint, a structure. The wealth quadrant is that blueprint for your money, and it breaks your portfolio into 4 simple parts, each with a specific job. First, you've got the foundation. This is your base layer, giving you broad exposure to the entire market, big companies, small companies, across every sector. This layer spreads risk and gives you balance without the need to guess which industry will perform best. Next is resilience, companies with size and stability that have weathered downturns and continued to deliver returns through different market cycles. When the economy gets shaky, this part of your portfolio acts like a shock absorber. Next, we add growth, the segment focused on innovation and expansion. These investments bring higher potential returns, helping the portfolio build wealth faster over the long term. Finally, there's income, dividend-paying companies that generate cash flow. Reinvesting this income compounds returns, steadily increasing both the portfolio's value and its payout stream. Together, these 4 quadrants, foundation, resilience, growth, and income, create a portfolio that is balanced, durable, and positioned to grow. And the most efficient way to build this system is with index funds, because they deliver diversification, low costs, and reliable market tracking without the need for constant stock picking. Now that you know the 4 pillars, the natural question is, why not just skip all that and put your money into a few hot stocks? After all, wouldn't it be faster to just find the next Amazon or Tesla and ride it to the moon? Here's the problem. Most investors lose money not because the market is broken, but because they're trying to beat it instead of benefiting from it. Stock picking sounds exciting. Everyone dreams of finding the next Amazon or Tesla early, but even professional fund managers with PhDs, massive datasets, and entire research teams fail to consistently outperform the market. In fact, more than 85% of actively managed funds trail their benchmark indexes over a 10-year period. If the experts can't do it, what are the odds for someone scrolling news headlines or Reddit threads? Then there's the stress. When you own just a handful of individual stocks, every piece of news feels like a threat. A single earnings miss, a lawsuit, or a shift in the economy can send your stock tumbling overnight. That pressure makes people panic sell, overtrade, or chase the next hot tip, all of which destroy long-term results. Index funds flip the equation. Instead of betting on one company, you own hundreds or even thousands. That way, if one stock tanks, no big deal. There are plenty of others picking up the slack. You're not gambling on one outcome, you're capturing the entire market's growth. You don't have to guess. Historically, the US market has returned around 10% annually. With index funds, you're automatically part of every breakthrough, every innovation, every new leader that rises. You don't need to find the next winner because you already own them all. So stock picking doesn't work, but what about chasing high-yield stocks for quick income? On the surface, it sounds tempting, but here's why that strategy so often backfires. The idea of living off dividends sounds amazing, right? Getting paid while you travel, relax, or just enjoy life. But here's the catch. Most people overestimate how safe those dividends are and underestimate the risks hiding behind them. High-yield stocks are the best example. When you see a stock paying a 6%, 10%, or even 10% dividend, it looks irresistible. Most of the time, that payout looks so high because the stock price has collapsed. And usually, there's a reason it collapsed. The business is struggling. When profits take a hit, those juicy payouts can shrink or disappear overnight. Instead of getting a steady income, you're left holding a falling stock that destroys your wealth. Both of these approaches, chasing high yields or gambling on the next big stock, have the same problem. They focus on short-term excitement instead of long-term results. Dividends that look safe can vanish. Stock picks that seem brilliant can collapse. So, if chasing yield and trying to outsmart the market don't actually work, what's the smarter play? The answer is simple: index funds. But here's the thing, not all index funds are created equal. Some are incredible wealth builders, and others not so much. That's why it helps to have a few clear rules to follow. Think of them as your checklist for picking funds that actually deserve a spot in your portfolio. The first thing to look for is diversification. A solid index fund spreads your money across hundreds or even thousands of companies so that one bad performer doesn't sink your portfolio. The second is dividend growth. A high yield today doesn't mean much if it isn't sustainable. What matters is a track record of companies raising dividends consistently, even during tough years. Third is cost. High expense ratios eat into your returns over time. Index funds stand out because they keep fees low, which leaves more of your money invested and compounding. And finally, long-term performance. A good fund has shown it can deliver steady results across different market cycles, not just in the good years. The 4 funds we're about to cover check all of these boxes. Each one fits into a specific role within the wealth quadrant system: foundation, resilience, growth, and income. Together, they create a balanced portfolio and complement each other's strengths. And it all starts with the foundation, an index fund that gives you ownership in thousands of companies across the US economy, all in one simple move. Fidelity Zero Total Market Index Fund with a ticker symbol FZROX. It was launched in 2018 with one clear mission: track the entire US market. That means big companies, mid-sized players, and even the smaller firms you've probably never heard of, across every sector. Instead of betting on a handful of winners, you're buying a slice of the whole economy. With more than 2,500 companies inside, it's one of the broadest ways to capture the growth of US capitalism. And unlike most funds, FZROX comes with a remarkable feature: a 0% expense ratio. Fidelity doesn't charge you a dime in management fees, which means every dollar you invest stays in the market working for you. What makes FZROX such a strong foundation is the way it spreads your money automatically. Some investors spend years trying to figure out which sector will perform best next year. Will it be tech, healthcare, financials, or energy? The truth is, no one knows for sure. But with FZROX, you don't need to guess. If one sector struggles, others usually step up. That natural balance smooths out the ride and makes your portfolio steadier over time. Of course, right now the US economy is heavily tilted toward tech, and FZROX reflects that. About a third of the fund is in technology, while financials, consumer cyclical, communications, and healthcare each take up about 9 to 14%. The top 10 holdings, big names like Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, Berkshire Hathaway, and Tesla, make up roughly a third of the fund. Yes, that's a lot of concentration in mega-cap tech, but because you've also got thousands of smaller companies in the mix, the risk is spread out. Now, income isn't the primary purpose of this index fund, but it does pay a modest dividend. The current forward yield is about 1.03%, with an annual payout of roughly 24 cents per share. That may not sound like much today, but what matters is the trajectory. The fund has grown its dividend consistently for 6 straight years, with an average growth rate of 19.8% annually. For long-term investors who reinvest those dividends, the growth compounds steadily in the background until it becomes meaningful decades later. Performance-wise, FZROX does exactly what it's supposed to do: track the market. Over the past year, it returned about 18%, almost identical to the S&P 500. Over 3 years, it gained nearly 58%. Over 5 years, about 92%. The numbers line up almost perfectly, which is exactly what you want in a total market fund. The bonus is that unlike the S&P 500, which only covers the largest companies, FZROX also gives you exposure to mid and small caps, so you're capturing a little more of the broader economy. Another strength of FZROX is its stability. FZROX has a turnover ratio of just 2%, which is just a fancy way of saying it hardly ever trades in and out of stocks. And the less it trades, the less you lose to fees and taxes, which means more of your money keeps compounding for you. Now, let's see what happens if you stick with this foundation fund, FZROX, and invest just $9 a day, about $3,285 a year. FZROX's current dividend yield is 1.03%. Its 10-year dividend growth rate, CAGR, is 19.8%. and its average annual share price appreciation is 13.42%. Based on these metrics, after 1 year, your balance from a daily $9 investment would be $3,285. After 10 years, it'll grow to $66,000. By year 20, roughly $364,000. And by year 30, around $2,012,000. At that point, the dividends alone pay about $104,000 a year, nearly $8,700 a month. This is the strength of FZROX as your foundation. Now let's add resilience, the piece that helps you stay steady in rough markets. In the end, I'll show you how to combine the index fund from each quadrant and build 2 complete portfolio strategies, one for income that pays around $7,000 in monthly dividends, and one for growth that can reach close to a $1.9 million valuation, all while investing just $9 a day. Back to the quadrant system. For resilience, I have Schwab Target 2045 Index Fund with a ticker symbol SWYHX comes in next. When you're building a long-term portfolio, it's not enough to just have a solid foundation. You also need balance. A foundation holds everything in place, but balance makes sure the structure can adapt and remain steady as conditions change. That's what SWYHX is designed to do. It blends growth potential with built-in risk management, making it a strong middle layer in this strategy. The way it works is simple. A target date fund like this fund automatically adjusts its mix of assets over time. Since it's set to 2045, it assumes you've got around 20 years or more before retirement. Right now, it leans heavily on equities for growth, but as 2045 approaches, it gradually shifts towards bonds and other stable assets. This glide path is powerful because it builds risk management into the design, so discipline happens automatically. Currently, it is primarily allocated toward US and international equities, with exposure spread across thousands of companies globally. Its holdings cover large cap leaders like Apple, Microsoft, and Amazon, as well as small cap stocks, giving investors a diversified reach into the world economy. Unlike single sector funds, it doesn't try to chase fads or bet on one area. It stays balanced by design. On top of that, it includes some fixed income for extra stability. It doesn't chase trends or gamble on one sector. It stays balanced by design. Income is another advantage here. SWYHX pays a dividend yield of about 1.86%, higher than FZROX, with a dividend growth rate CAGR of 13.14%. These payouts have grown consistently, so you get both income today and growth for tomorrow. On performance, the numbers are steady. Over the past year, SWYHX returned 13.43%. Over 5 years, it's up 54.4%. Its annual share price appreciation averages 7.59% since inception, which may not be flashy, but shows reliable compounding. Risk management is built into its structure. With a turnover ratio of 14%, it makes allocation adjustments without overtrading. And as 2045 approaches, the shift from equities to bonds reduces volatility naturally. Now, let's see what happens if you put in the same $9 a day. After 1 year, your balance will be $3,285. After 10 years, it would grow to about $53,000. By year 20, it reaches roughly $218,000, and by year 30, it climbs to around $922,000. At that point, the dividends alone would be paying about $70,000 a year, or roughly $5,900 a month. With foundation and resilience in place, the next step is growth, the engine that pushes your portfolio further. For that, I have Fidelity NASDAQ Composite Index Fund with a ticker symbol FNCMX. This fund tracks the NASDAQ Composite Index, giving exposure to one of the most innovative and disruptive corners of the US market. With nearly 2,900 holdings, it's broad, but unlike FZROX, it leans heavily toward tech and communication giants. Over half the fund, about 52%, sits in technology, with communication services around 15% and consumer cyclicals about 14%. The top 10 holdings alone make up nearly 60% of the portfolio, led by names like Nvidia, Microsoft, Apple, and Amazon. This level of concentration magnifies both the risks and rewards. When these companies soar, the fund outpaces the market. When they stumble, the ride gets bumpier. Meanwhile, here the dividends are not the attraction. FNCMX has a low forward yield of just 0.53%. Investors looking for income will find little here, but that's not this fund's job. It is here for massive capital appreciation. Performance shows why it's the growth engine. Over the past year, FNCMX gained 26% compared to the S&P 500's 17.67%. Over 3 years, it's up more than 81%, and over 5 years, it's gained 102% consistently outrunning the broader market. But with that speed comes volatility. Downturns hit harder, like early 2025, and only patient investors who stay the course capture the rebounds. Risk is therefore an essential part of the FNCMX story. With its heavy concentration in tech and communication and more than half of its value tied up in just 10 companies, this fund is more volatile than a diversified market fund like FZROX. The high potential rewards come hand in hand with sharper declines during corrections. Its 2% turnover ratio does provide efficiency, but this is not a low volatility holding. It requires patience and the ability to withstand market swings. Now let's run the numbers if you put $9 a day into this index fund. After 1 year, your balance will be $3,285. After 10 years, it will grow to about $78,000. By year 20, it's around $488,000. By year 30, the balance is projected to be about $2,625,000. Dividends at that point are small, about $2,000 a year or roughly $200 a month. So, FNCMX is in many ways the embodiment of growth investing. It doesn't provide the steady balance of a total market fund, nor the income of a dividend-heavy strategy. Instead, it offers something equally important, the chance to accelerate wealth by capturing the upside of innovation. But it has its risks as well. In the end, I'll show you how to combine the index fund from each quadrant and build 2 complete portfolio strategies, which reduce risk and still have the potential to reach close to a $1.9 million valuation. Growth is good, but wealth isn't just about bigger numbers on a screen, it's also about income that you can actually use. That's why the final quadrant, income, is where Vanguard European Stock Index Fund Admiral shares with a ticker symbol VEUSX come in. Every portfolio built to last needs an income engine that extends beyond the US, and this index fund provides exactly that. Where a US core leans heavily into domestic tech and consumer-driven growth, this fund spreads your capital across developed Europe's major economies: Germany, the UK, France, Switzerland, the Netherlands, and others. With an expense ratio of just 0.08%, more than 1,250 holdings, and no single company or sector dominating, it offers investors a broad and low-cost way to gain exposure outside the United States. What makes this fund such a strong income choice is the way its dividends are backed by some of Europe's most established companies. VEUSX holds over 1,250 stocks, and its top 10 make up only about 16% of the fund. Big names like SAP, ASML, Nestle, AstraZeneca, Roche, and Shell anchor the portfolio, while diversification across sectors keeps it balanced. Financials account for about 23%, industrials around 20%, and healthcare about 13%, with the rest spread across consumer goods, technology, and energy. This wide reach adds stability, but the real strength is in the steady dividend stream, which makes VEUSX such a valuable piece of a long-term plan. The dividend yield is currently 2.87%, with a dividend growth CAGR of 11.18%. Those payouts are backed by Europe's most established companies and have a history of consistent growth. Reinvesting them accelerates compounding, which is where VEUSX really shines. In terms of performance, VEUSX has delivered steady results, about 14% over the past year, 46% over 5 years, and 56% over 10 years. These returns may look modest compared to US growth-heavy funds, but that's exactly the point. VEUSX provides balance and reduces the risk of relying too much on one market. The risk profile reinforces this, with a 24-month beta of 0.71 and turnover of just 3%, signaling lower volatility and greater tax efficiency. Now, let's run the numbers if you put $9 a day into VEUSX. After 1 year, your balance would be $3,285. After 10 years, it will grow to about $49,000. By year 20, the balance would be around $213,000. By year 30, it reaches about $1,266,000. And the standout feature is the income stream. Dividends alone would pay about $192,000 a year, or roughly $16,000 a month. Now you have an index fund for foundation, resilience, growth, income. So far, we've broken down each fund individually, but what happens when you put them together? Let's look at how the full portfolio performs over time and what kind of wealth it can realistically build. But here's the thing, depending on what stage of life you're in or what kind of investor you are, there's more than one way to use this setup. You can take the same building blocks and shift the weight to match your goals. Some people want their portfolio to start paying them sooner. They're thinking about income, maybe even early retirement. Others are laser focused on growing their money as fast as possible and letting it compound for the long haul. So let me show you and Josh two real strategies you can use with these same funds. One is all about dividend income, the other leans hard into growth. Both are smart, both are simple, and both are built with purpose. Let's start with the dividend-focused portfolio. This one is designed to pay you back with real income when you retire. This portfolio is for investors who love the idea of getting paid to own strong companies. It's built to generate solid cash flow, but still give you long-term growth. You're not just collecting checks, you're building wealth too. So here's how you set it up. For this portfolio, you'd put 40% of your money into FZROX for broad US exposure, another 40% into VEUSX because that's the powerhouse for dividends. Then you give 10% each to SWYHX and FNCMX, so you've got resilience from the target date strategy and growth from innovation. Together, that balance makes the portfolio both durable and rewarding. Now let's figure out how much income this portfolio can actually produce. For this, I look at the dividend yield of each fund, then weigh them based on their share of the portfolio. FZROX yields 1.03%, SWYHX yields 1.86%, FNCMX yields 0.53%, and VEUSX yields 2.87%. But remember, we can't just take a simple average, because the portfolio isn't evenly split. VEUSX and FZROX together make up 80%, so they have way more influence. So you multiply each index fund's dividend yield by how much of the portfolio it represents. For FZROX, that's 40% or 0.4 times 1.03%, which gives us 0.412%. Then we do the same for the others. VEUSX at 40%, 0.4 times 2.87% equals 1.148%. SWYHX at 10%, 0.1 times 1.86% equals 0.186%. FNCMX at 10%, 0.1 times 0.53% equals 0.053%. Add them up and you get 1.8% total dividend yield for the whole portfolio. You can do the same for dividend growth and share price appreciation. Weighting those based on the portfolio allocation gives us a combined dividend growth rate of about 14.87% annually. And for share price appreciation, the averages come out to about 9.71% a year across this mix. Now here's where it gets exciting. I ran the numbers on what this portfolio could become over time, assuming you invest $9 a day, every single day, and reinvest all the dividends back into the portfolio. After the first year, you'd have about $3,285 invested. Stay the course, and by year 10, you're looking at around $58,000. 2 decades in, it grows to about $269,000.
And if you stick with it for 30 years, you'll be sitting on roughly $1,252,000.
By that 30th year, this portfolio would be paying you close to $82,000 every single year. That's about $6,900 a month in dividends alone. If you add it all up, the capital growth plus all the reinvested dividends, you're looking at a total value added of about $1,153,000 over those 3 decades. Roughly $711,000 comes from share price growth, and the rest, a solid $442,000, is from reinvested income. But let's say you're not looking for income right now. Maybe you're in your 20s, 30s, or even 40s, and your main goal is growth. You're not thinking about cash flow yet. You're focused on building the biggest portfolio possible, so you can have options later. That's where the growth-focused portfolio comes in. This one's built for people who want maximum acceleration. Instead of chasing dividends, you tilt heavily toward innovation and high-growth companies. The goal is simple: let compounding drive your wealth as fast as possible. Here's how the setup works. You'd put 70% into FNCMX because that's the growth engine with some of the strongest appreciation numbers. Then you add 20% into FZROX for balance across the whole market, and give 5% each to SWYHX and VEUSX. If you allocate investment this way, the overall portfolio will still have a yield, it's just low, around 0.81%. And that makes sense. This portfolio is focused on appreciation, not income. The same goes for dividend growth. Since we're not building it around income funds, the average growth rate is about 13.35% a year. It's there, but it's not the priority. Where this strategy really shines is in share price growth. When you look at how fast these funds have appreciated, especially FNCMX, the numbers are seriously impressive. Weighted together, this portfolio's average annual price appreciation is around 15.78%. That's where the firepower comes from. So let's run the same $9 a day scenario and see what this thing can do over time. After year 1, just like before, you would have about $3,285 invested. But hang in there, and by the 10-year mark, you're already at about $72,000. Stay consistent, and by year 20, that grows to around $397,000. Push all the way to 30 years, and this portfolio could be worth roughly $1,859,000. That's just shy of $2 million. And remember, that's without chasing high yields or trying to time the market. Just consistent investing, reinvesting everything, and letting the math do its thing. Now, the dividend income from this strategy, it's not much. By year 30, you'd be getting around $6,000 a year, which works out to around $530 a month. But that's the trade-off. You're not collecting big checks today. If you look at the total value added over those 30 years, it's huge. You're looking at about $1,760,000 in gains, with $1,711,000 of that coming from price growth and about $50,000 from reinvested dividends. It's a very different approach. The dividend-focused portfolio puts money in your pocket sooner and gives you steady, reliable growth along the way. The growth-focused portfolio, on the other hand, skips the short-term income and leans into compounding, building a much larger balance for the future. Same funds, same building blocks, but two completely different outcomes. So the real question is, which path fits you better? Because it's not about one being right and the other being wrong, they're simply different tools designed for different goals. Once you know what you want your money to do, the choice becomes a whole lot clearer. Want to know how to turn a one-time $500 investment into a portfolio that pays over $5,000 in monthly dividend income? Click the video on screen to find out.